Well, thank you very much for joining us tonight. I'd like to start by telling you a bit about the Federal Reserve and why we value very much the opportunity to interact with you in events like this one. And then I'll share some thoughts on the state of the labor market. I'm going to leave plenty of time at the end for your questions on that issue or any others that may interest you, so please think of questions along the way. Let me note that the views I express tonight are mine and not necessarily those of anyone else at the Federal Reserve Bank of Minneapolis or in the Federal Reserve System. So as you'll know, if you've been here before or if you watched the video, the Federal Reserve is our nation's central bank. The Fed supervises banks to ensure their safety and soundness, operates parts of the payment system, and conducts monetary policy, which basically means adjusting interest rates, to achieve two goals assigned by Congress: maximum employment and stable prices. I'm going to come back to those two dual mandate goals in a moment because they're central to what I want to say about the labor market. So the Fed consists of the Board of Governors in Washington and the 12 reserve banks responsible for districts around the country. The Minneapolis Fed covers the 9th district, which includes the Dakotas, Montana, parts of Wisconsin and Michigan, and of course Minnesota. So the Fed's monetary policy arm is the Federal Open Market Committee, or the FOMC. And the FOMC consists of the members of the Board of Governors and a rotating group of presidents from the reserve banks. Even though only a subset of the reserve bank presidents vote at each FOMC meeting, they all participate in the discussion and share their views on the economy and monetary policy. So that decentralized structure means that a crucial part of our reserve bank's work is to gather information about the local economy and bring that information back to Washington, where it is used in determining the course of policy. And then to bring information about monetary policy back to our district, where we can share it with you. Some of our information gathering is analytical, with economists in our research division crunching the data to learn where the economy is headed. But quantitative data are imperfect and they take a long time to arrive. Numbers alone also don't provide really important context about what families and businesses are actually experiencing. So we highly value the anecdotal real-time information that we get by talking with people like you and communities throughout our district. So I look forward very much to your questions and comments later this evening. So how is the economy doing? As I mentioned, the Fed's goals are maximum employment and price stability. And so a crucial task for Fed economists is to assess the economy's performance relative to those two goals. On price stability, the assessment is fairly straightforward. The FOMC has interpreted the price stability goal to mean an inflation rate of 2%. In the aftermath of the Great Recession, inflation has actually been averaging a bit below that target, although of course it does fluctuate substantially from month to month. Looking through those fluctuations, most forecasters expect inflation to rise only gradually toward the 2% target. On the inflation front, then, the economy still has ground to make up. Now let's turn to employment, which is my main topic for this evening. In contrast to price stability, where the Fed has a numerical target of 2% inflation, the FOMC has said that it doesn't have a fixed quantitative target for employment. That's because many factors besides monetary policy, such as demographic shifts, employers' changing needs, and government programs, can significantly affect the maximum level of employment. In consequence, deciding how close the economy is to maximum employment can be one of the most challenging questions that monetary policymakers face. Tonight, I'll give you a guided tour of some of the main metrics that economists use to assess the employment situation, with a view to trying to answer a deceptively simple question: has the economy returned to maximum employment? Or, more concisely, are we there yet? I called that question deceptively simple because although the numbers are straightforward, their interpretation is anything but. The numbers are going to show us this evening, over and over, in a variety of ways, that a much smaller fraction of Americans has good jobs today than did before the Great Recession. But is that enough to say that we aren't currently at full employment? Does the boom economy of 2006 and 2007 define the maximum even for today? Or has the structure of the economy changed in ways that make those old peaks impossible to reach now? These are, as I said, tough questions, but I will keep coming back to a simple theme. The recovery in the labor market is not yet complete. Although we may not be entirely sure how far we are going to go, we definitely aren't there yet. So imagine that you sit on the FOMC and you want to decide how the labor market is performing. You might begin by looking at the unemployment rate. Nationally, it peaked at 10% in late 2009 and has been falling slowly since then. It's now down to 5.9%. This progress is significant. It means millions more people have jobs. But how can we tell whether it's enough, whether unemployment has fallen as far as it can? As the graph shows, unemployment remains well above its pre-recession minimum of 4.4%. If the economy's best performance on unemployment during 2007 represents maximum employment for today, we still have a long way to go. Perhaps, though, today's economy can't attain an unemployment rate as low as we saw 7 years ago. Some workers back then were building homes financed by a credit expansion that proved to be unsustainable. Now that regulations are in place to prevent financial bubbles, perhaps maximum employment is lower and minimum unemployment is higher than in the past. The economy has also changed in other ways. For example, during the worst of the recession, many displaced workers were eligible for extended unemployment insurance benefits. Many economists estimated that those benefits pushed up the unemployment rate by about 1 percentage point, an effect that has since waned as benefit extensions end. Adding up all of the changes in the economy, most FOMC participants say that the unemployment rate in the long run should be between 5.2 and 5.5%. So we may be getting close, but we aren't there yet. Now here in Minnesota, the story on unemployment is a little different. The recession was less severe in our state, and unemployment has mostly recovered to its pre-recession level. So you might be tempted to conclude from this picture that the labor market recovery is complete here in Minnesota. But some other statistics we'll see later tonight suggest a different conclusion. Now the unemployment rate is an average for all workers, but no one worker is average. Different workers face different labor market conditions, and those variations are important in deciding how well the economy is doing. One major source of variation is education. In both good times and bad, the unemployment rate is notably higher for people with less education. Unemployment also increased much more during the recession for people with less education. But the recovery has been slow in all education groups. Across the entire range of education levels, the unemployment rate remains significantly higher today than it was before the recession. What's more, at every level of education, the unemployment rate is about as bad right now, today, well into the recovery, as it was at the worst point in the last business cycle. Unemployed workers are sometimes quoted in the newspaper asking, "What recovery?" When we look at statistics like these, it's easy to see why they ask. We can also break down the unemployment rate by race and ethnicity. Again, we see large variations across groups. And again, the unemployment rate today remains higher than the pre-recession level for every group. In some cases, these unemployment rates are extraordinarily high. The unemployment rate for Black Americans this September was 11%. Of every 1,000 Black Americans who were trying to find work, 110 could not do so. Such a high unemployment rate suggests, to me at least, that we remain far from having a labor market that fully uses the capacities of all Americans. So what is unemployment exactly? The Bureau of Labor Statistics measures the unemployment rate by surveying households around the country. People in the survey are asked whether they have a job, and if not, whether they have been trying to find work. To count as unemployed, you must be available for work now, and you must have actively looked for work in the past 4 weeks. That's a pretty restrictive definition. Every month, many people tell the survey workers that they want a job, or they have wanted one in the recent past, but they haven't looked in the past 4 weeks. Some of these people are what economists call marginally attached workers. They've looked for work in the past year, but not lately. If we count those marginally attached workers as unemployed, we get a higher unemployment rate, 7.3%, that the Bureau of Labor Statistics calls the U5 rate. Now, there are other workers who are just underemployed. They would like to have full-time jobs, but they can find only part-time work. If we include those underemployed workers in the jobless rate, it's called U6, and it jumps up to 11.8%. Both U5 and U6 are substantially above the level before the Great Recession. This tells us that the recession, which, let's recall, officially ended in June 2009, more than 5 years ago, produced a long-lasting increase not only in the number of workers who can't find jobs, but also in the numbers who have become too discouraged to look for work, or who cannot get as many hours as they want. Of course, other ongoing changes in the economy might be responsible for some of these shifts. For example, the growing service sector and improvements in information technology that allow businesses to schedule workers more efficiently might be raising the number of part-time jobs. It can be challenging to distinguish such long-run trends from the imprint of the recession. However, these trends have been going on for some time, and they do not seem to have changed dramatically in recent years, so it's unlikely that they're entirely responsible for the current elevated rates of discouragement and involuntary part-time work. As Federal Reserve Board Chair Janet Yellen said last month, there are still too many people who want jobs but cannot find them, too many who are working part-time but would prefer full-time work, and too many who are not searching for a job but would be if the labor market were stronger. So now we've looked at three measures of the health of the labor market: the unemployment rate, U5, and U6. Is our assessment done? Hardly. As Chair Yellen's comment and the statistics on marginally attached workers suggest, the unemployment rate is not a complete measure of the health of the labor market. We must also pay attention to those who are not even searching for a job. The unemployment rate divides the number of people currently seeking a job by the number seeking a job plus the number who have jobs. That denominator, the number of job seekers plus the number who have a job, is called the labor force. We can measure people's interest in having a job by looking at the labor force participation rate, the labor force divided by the adult civilian population. And here it is. In September, the labor force participation rate was 62.7%. That's the lowest reading in more than 30 years. Now, as you can see from the graph, labor force participation is mainly moved around by long-term trends. In the 1980s and 1990s, the rising number of women in the workforce drove up the statistics. More recently, labor force participation has fallen as the baby boomers reach retirement age. Economists have reached a wide range of conclusions about whether those and other demographic trends entirely explain the current low level of labor force participation, or whether some short-term weakness in the economy is also a factor. In a recent paper, a group of Federal Reserve Board economists concluded that low labor force participation was largely due to long-term structural changes. I greatly respect this work, but I am not totally sure I agree. The study notes that younger cohorts of workers will continue to stay out of the labor force. It notes that younger cohorts of workers have unusually low participation rates. Now, the economists assume that these younger workers will continue to stay out of the labor force in large numbers as they age. That's certainly possible. But these cohorts might also be working less because our current economy, which has dominated their careers so far, is quite weak. Perhaps they would come back to work if the economy only strengthened. Only time will reveal the answer. We can also look directly at the percentage of people who have a job, the employment population ratio. Like labor force participation, the employment population ratio moves in response to long-run demographic trends, but it is also buffeted by economic shocks. During the Great Recession, it is fair to say that the employment population ratio fell off a cliff. Since then, it has recovered only slightly. Now, there are three ways to interpret this picture. One is that an employment rate of around 63%, like we saw just before the recession, is normal. And so we remain very far from maximum employment. But there's little sign in this graph that we are actually moving back to the old normal. If this graph were your only information on the labor market, you'd probably be very tempted to conclude that we now have a new normal with much lower employment rates than in the past. Both of these two interpretations, that normal is the old normal or that normal is the new normal, are a little extreme. A third interpretation is that demographic trends mean the maximum level of employment was gradually falling anyway. Perhaps 59% employment wasn't normal in 2009, but eventually it will be. We're not there yet, but we're getting there. We can adjust partially for demographic trends by looking at the employment population ratio among people ages 25 to 54. So this statistic excludes people who are most prone to retire or to enroll in higher education. But it is still affected by other trends, such as changes in women's labor force participation and in the rate of disabilities. Here we see somewhat more recovery in employment than among the population at large, but employment remains quite low compared with the recent past. It seems likely that employment among these prime-age workers has room to recover further. By now, we've accumulated a lot of measures of how many people have jobs and how many are looking. But for most workers, having a job is not enough. They want a good job. One simple metric of whether people have a good job is the percentage who want full-time positions, but can find only part-time work. In both the US and Minnesota, this figure spiked during the Great Recession and remains far above its previous level. As I mentioned earlier, part-time work may be rising in part because of long-running changes in the structure of the economy. But some analysis also indicates that involuntary part-time employment is associated with slack in the economy. The persistently elevated rate of involuntary part-time work here in Minnesota therefore suggests that our state's labor market recovery is not yet complete. We're not there yet, despite our low unemployment rate. Another measure of the quality of jobs is how much they pay. Average hourly earnings lately have been rising by about 2% a year, or just a little faster than inflation. Now that might sound okay, but it's lower than was typical in the past, because workers' pay usually grows as fast as inflation, plus improvements in productivity. One sign of a complete recovery in the labor market will be when employers feel enough competition for workers that pay rises at a faster rate. Again, we're not there yet. So in conclusion, determining the maximum level of employment is a challenge. But from the statistics we've reviewed tonight, and many others that economists look at, it seems safe to say that we're not there yet. Now, people sometimes want to know exactly how close we are to maximum employment because they fear that inflation, the other piece of the FOMC's dual mandate, will take off if the labor market does too well, if the unemployment rate gets too low. As I mentioned at the outset, inflation is actually below the FOMC's target right now, so an increase in inflation would help achieve the goal. But even if inflation were right at the target, a long line of analysis done here in the research department at the Minneapolis Fed suggests that low unemployment in and of itself would not be cause for concern about price stability. Inflation turns out to be more or less what statisticians call a random walk. The best guess for the inflation rate in the future is the inflation rate today. Given the inflation rate today, unemployment has little additional predictive power for future inflation. Here's a graph of the unemployment rate against year-over-year changes in the inflation rate. And what this graph shows you is that there's no more reason to expect a rise in inflation when unemployment is low than when it is high. So as we close in on maximum employment, we'll need to keep an eye on the inflation numbers, just as we always do, but we should not fear having too many jobs. The reason to worry about jobs is that there are too few. We're not there yet. Thank you for listening, and I'd be happy to answer any questions.